Welcome back. I'm Pierre Daillie, and this is Raise Your Average. Mike Philbrick is here with me. Markets, policymakers, and investors are still analyzing energy, geopolitics, and resources using outdated mental models, treating crude oil as the whole system, assuming peace is the default state, underestimating China's industrial competence, and believing resource security is someone else's problem. Those blind spots are not theoretical. They distort oil price signals, hide looming supply shocks, misread China's war prep behavior, underestimate shale breakthroughs, and leave Western democracies dangerously exposed to resource coercion, from potash to uranium to hydrocarbons. Our guest today, Doomberg, has a distinct and very meaningful way of reframing the world as it actually operates. Molecules over narratives, stockpiles over statements, technology over legacy metrics, and power over platitudes, forcing investors and advisors to abandon comforting myths and adopt systems-level thinking. Here in this episode, we're going to strip away the polite fiction of modern markets and geopolitics with Doomberg to reveal how energy molecules, resource stockpiles, and technological leverage are quietly reshaping power and portfolios.
This is Raise Your Average, dedicated to making you a better long-term investor. Join us as we sit down with some of the most interesting names in finance to discuss macro, markets, investment strategies, and more.
Doomberg, welcome back to Raise Your Average. It is terrific timing to have you.
Pierre, Mike, great to be back with you. I always enjoy our discussions, and there's certainly no shortage of interesting things for us to unpack, both globally and within Canada itself, too. So lots to go over.
Doomberg, let's jump in. You've written recently, and in the lead up, actually, to your credit, you've written a fair bit about Venezuela prior to the New Year's Day actions of the White House. From Venezuela to Guyana, you suggest that oil isn't just economics, it's destiny. How should investors think about geopolitical option value embedded in resources?
Yeah, it's a great question. The subject of Venezuela and Guyana had indeed been on our radar. And in fact, all the way back in December of 2023, we started down this journey in a piece called The New World's Oil, where we made what we thought was the salient point that the Western Hemisphere was already outproducing the Middle East in terms of oil and vastly outproducing the Middle East in terms of natural gas, which is a subject we're returning to here soon. The Middle East pivot to natural gas is an interesting geopolitical development in and of itself. But in The New World's Oil, we cataloged just the amazing inventory of possibilities that exist in the southern part of the Western Hemisphere in particular, Argentina, Brazil, Colombia, Venezuela, Guyana, even Cuba. And we pointed out that physics indicates that this must eventually come back under the scope of American interest. And of course, we could never have imagined to have been as right as we were. We followed up that piece with one that we published on Trump's inauguration day last year called Misreading the Room. And the social preview was, if Greenland is the appetizer, might Maduro's Venezuela be the main course? And both of those indications came true. And how does one see such things happening in advance? Well, you begin with a resource-first mindset and assume that the narratives will fit the resource. And one thing that investors fail to understand, I think, or at least perhaps don't lend enough credence to, is that in the resources game, possession is 90% of the value. So all of this talk about Venezuela's economics and it's heavy and, it's going to take a long time and it's going to cost a lot of money, that doesn't matter. What matters is possessing. It takes $20 billion to build an LNG terminal, and yet they still get built. So what does it matter if it's going to take 5, 10, 15, or $50 billion to develop Venezuela's resource accumulation? And so obviously we couldn't have predicted the shocking nature of the tactics used to execute the snatching of Maduro. by the way, the descriptor you use to describe that event is a tell into your geopolitical worldview. I note with interest that many in the global south call it a kidnapping of Maduro, while those in the sort of traditional West have been labeling it an arrest.
Right.
I'd probably lean closer to the kidnap side of that ledger, but yeah, that's that. It happened, and so you have to deal with reality of the day. But just looking at resource first allowed us to also predict the Malay bailout in Argentina. We wrote a piece called Mosaic Theory, where we sort of followed up the New World's oil by reassessing on a country by country basis what was likely to happen in the southern part of the Western Hemisphere, given this clear signals the Trump administration had been giving. And so, I'll conclude the first answer by saying we often say that energy and, of course, the other commodities are just derivatives of energy. The fact that people don't start with energy is surprising to us because while it doesn't explain all of the variance, no single variable explains more, in our view.
On that point, how much of it, energy importance and location to some degree, I guess, how much of this is hemispheric consolidation and that sort of thing going on? And maybe, something to ponder is how the pricing is happening slowly. Do you see a world where the option value gets priced suddenly instead of more slowly?
So one of the things that the free market does very poorly is pricing geopolitical risk and pricing national security value in particular. And those imperfections in the market really are what lead us to the point where Western manufacturing gets hollowed out, or the value of China's environment gets underpriced, and so on. And so the fact that, the U.S. no longer makes magnesium, for example, because it is environmentally taxing to purify, comes with geopolitical penalties that the Chinese are now using to their advantage. And we wrote this a couple of years ago in a piece called Geopolitical Warfare, and the fact that China was willing to debase its local environment with specific geopolitical objectives in mind is the part that is just not priced correctly in the market. Now, how do you reduce that down to security by security, lead development? We leave that to others who do it professionally. But I think for a level setting direction of travel, if you just start with energy, a lot of stuff becomes self-explanatory. So, for example, the ongoing deindustrialization of Europe is just not going to get better. We note with interest that Ed Miliband was out bragging about how the North Sea is going to be a wind corridor. And that, clearly all of the evidence so far means that, Britain has to go further down the tracks of weaning off of fossil fuels, which is literally quite 180 degrees backwards from reality. And so if you're thinking about going long British industry, you have to wonder what the true pivot point would be. And that, in our view, that would be Miliband's exit from the stage. So that's just a couple of examples of how energy is at the forefront of what you should be thinking about.
I'm always amazed actually at how the idea of, free trade and just in time and, outsourcing the inventory was, we didn't, in the West, didn't sort of think that through in a longer term perspective. And then we have this moment of realization within the last year or so that the hollowing out of the industrial complex, as you state, and the fact that those industries are based on access to energy in order to create those products and underlying structures. And as you see Europe trying to sort of reindustrialize, I'm wondering where they're going to get the energy in order to do that.
Yeah, we wrote a piece called Project Porcupine where we explain that Europe simply doesn't have the jewels to build a military industrial complex. I mean, bombs are concentrated forms of energy released in small, tight environments to destroy your enemy. Wars are energy wars. So to your broader question, though, and this is, I think, pretty significant and explains, in our view, at least some of the recent price action in gold. Wall Street long ago convinced corporate insiders to trade resilience for efficiency. And they were rewarded handsomely for that. Stock options, Ben Hunt has a whole thesis Ben Hunt from Epsilon Theory has a whole thesis about how the principal agent problem that arises from the manner in which corporate executives are compensated in the modern Western financial markets is real. And it rewards short-termism. And, if announcing that you're shutting a factory in Pittsburgh and you're opening it outside of Shanghai causes your stock to go up 8% and pushes your relatively short-term options that have been granted to you by your board into the money, then guess what happens? Pavlov's dog. You keep doing that, and eventually you end up where China has all the cards, and Chinese executives are not compensated in that way. They're compensated through party loyalty, contribution to China's geopolitical strength, and so on. And so Trump, for all of his flaws, I think intuitively recognizes that. And something very important happened yesterday after the market closed, which, the U.S. dollar's been weak. Gold has been rallying. Trump was asked about it, and he says, I'm fine with it. And in fact, what that really signaled to the market is that Trump is serious about reindustrializing. Because if the editor of Doomberg keeps reminding me that we is me, if the West is truly serious about reversing 50 years of certain financial policies, then all of the trends that were dominant over those 50 years have to reverse. And so instead of deflationary outsourcing, we're going to have inflationary resourcing.
Yeah.
And gold is telling you that. Instead of a strong dollar, as good as gold for oil, the U.S. needs a weaker dollar in order to make its exports more competitive. Trump has been very, very clear. Trump is many things. We like to say Trump is everything his strongest critics and strongest superfans say he is, all at once. He's all of those things. He is not subtle. So he campaigned on tariffs and reindustrialization and cheap energy. He's implemented tariffs. He's gone around the world trying to smoke out sovereign money to come back to the U.S. and to pay for the reindustrialization of the U.S. And also, he is clearly not perturbed by a weakening U.S. dollar. And that's what gold, look what happened yesterday. He made those comments and gold rallied, $200?
Yep.
In 10 minutes? I mean, the market is telling you something. We're at an amazing change. And so last point I'd make, which is a great point that I lifted from reading my friend Luke Roman's latest weekly newsletter, which is this sovereign money that is going to underwrite the U.S. industrial renaissance is already in the U.S. in the form of stock holdings. And so if Japan or Korea or these other countries, Qatar or the UAE are going to be investing, quote, billions of dollars in the U.S., it's already invested in the U.S. It's just going to change where it is on the balance sheet. And if anything, I think that is kind of added to the pile of risks that are currently holding up the U.S. Stock market and tech stocks in particular.
So how do you see that actually changing the way it's interacting with the U.S. holdings? I mean, how do you, can you pull on that thread or just dig down that hole a little bit more?
Sure. So there's a lot of moving parts, and probably many listeners aren't really familiar with what Trump is doing because it's all buried in this sea of propaganda. The U.S. is in the middle of a civil war right now. I don't think that it is, too exaggerative to say that the country is split. We see what's happening in Minnesota. We see the polarity that Trump generates. The polarity that Trump generates on the international scene is in no way any greater than the polarity that he generates domestically, just for the record.
It's quite a diversion.
Yeah. And so, when you look at what Trump is trying to do, let's take the quote trade deals that he signed with Japan and Korea. Korea is going to help the U.S. Rebuild its shipbuilding capability, and Japan's going to help the U.S. rebuild its nuclear capacity. And those, as we jokingly said in one piece, the U.S. is going to embark on a nuclear renaissance and Japan is going to pay for it. It's kind of like, like what he said when he came down the escalator about the wall in Mexico. There's truth to that. And so we see in the private markets an avalanche of money coming in looking for investments to make that will help Trump achieve his, U.S. domestic manufacturing renaissance. But we also see hesitation. People are wondering about the political longevity of Trump. The midterms are just around the corner. The 2028 elections aren't that far off. And we just wrote a piece about the incident in the East Room between ExxonMobil's CEO Darren Woods and Trump about Venezuela. We read way more meaning into that affair than I think most did for the reasons we articulated in that article. So the moving parts about what Trump is trying to do and whether he can achieve it is there's a lot of game theory being played by the key participants. Like, do you want to cut a check for $5 billion if you're Middle Eastern Sovereign Wealth Fund A, only to find out that Gavin Newsom's in the White House now and everything that Trump tried to do is now toxic? So the political cycle is increasing both in amplitude and frequency. And it is long ago shorter and more violent than the capital cycle of heavy industry. And that's the fundamental challenge that Trump is facing right now.
Yeah, Doomberg, you had a couple of key points that you made that I want to pull on. One is the trading, for resilience, which explains the positioning around gold. But the other is also, the mindset of reversal that somehow Trump is okay with the dollar weakening and he's okay with, time travel, right? Reversal back to undo the policies that made the last 50 years. That really speaks to everything that is going on. I mean, when you tie that into it's completely antithesis to the politics he ran on to get elected, and he's being called out for it. But it doesn't change the fact that there's an enormous amount of diversion that's occurring, both geopolitically and domestically in Minnesota, that is a distraction from what is actually going on behind the scenes or behind the curtain.
Yeah. So Trump did run on the core of what he's trying to do. If you go back and watch his campaign videos, Agenda 47, he laid all this out in some detail. I'd say where he has diverged most prominently from his campaign promises has been the continuation of these foreign wars and foreign adventures militarily. On the domestic front, I think he has tried to execute what he campaigned on. My main fear is whether he, and this is no criticism of him because I don't know that it's knowable, whether he fully understands the second and third and fourth order consequences of what he's trying to do. Because there's many who argue credibly that there is no path out of the fiscal dominance spiral that the U.S. currently finds itself in. And it's entirely possible that things go haywire under his watch and then he gets blamed for it and then the old powers come right back in and revert back to the old mean. Not that that's right. A solution either. But whether he has the political maneuverability to execute what he's trying to do is the open question. And one of our operating mental models is that if we had a secret ballot in Washington, 80% of the House and Senate would vote to impeach and remove Trump. He does not have political flexibility. There's no such thing in D.C. as Republican and Democrat in the way that people traditionally think and the way that the media is portraying the team sports aspect of the political brawls. If you believe that in a secret ballot, 80% of the Senate would vote against Trump, it makes perfect sense that the quote-unquote Republicans are not nuking the filibuster in order to implement Trump's agenda. They have a majority. They could do it today. It is widely believed that the Democrats would do it if they retain the Senate, or if they retake the Senate, and then if Newsom wins in 2028. And yet the Republicans aren't doing it. Well, because they're not Republicans. They're all members of the same party, and they're all objecting to Trump's agenda. The people that wear the Democratic jersey are doing it loudly, and the people that wear the Republican jersey are doing it passive aggressively. But once you understand that there's no such thing as a Republican in DC, then things become a lot easier to understand, and then allows you to make some predictions about what's going to happen and what's not going to happen. And it also explains Trump occasionally recognizing that he has limited political flexibility in certain domestic and geopolitical adventures.
So when all of this noise, hits the headlines, because it's every day, and you're watching with interest, how do you go about separating the signal from the noise?
Yeah, so some of the tactics that we use, first thing we do is we try to read everybody's propaganda. So if you're only limiting your inflow of information to one country, your home country is what most people limit their input of information to, then you're missing a broad part of the picture. And so we try to read the global propaganda around major events to the maximum extent possible. So just Mark Carney's speech in Davos, we know how it was received in Canada. We know how it was received in Britain and Western Europe. How it was received in China is actually a very interesting question, and how it was received in Brazil and Indonesia gives you a whole different view of that speech. And so in order to get closer to the truth, the first thing you have to do is escape the shackles of monolithic propaganda. You also have to understand that everybody is publishing propaganda, consciously or subconsciously, and that it's important to sort of ask the question of why am I reading this now and who is saying it to me? It's impossible to fully escape propaganda. We recognize that we're victims of it just like anybody else.
Mm-hmm.
But if you read enough of it, you get trained in this, okay, that doesn't make sense. Or I understand why this is what, the Globe and Mail is saying. But why is it materially different than what, the Jerusalem Post is saying or TASS is saying in Russia? And the information is almost always embedded in the differences. And then the second thing I would say is the power of markets, both financial and predictive markets, to give you insight into what's really going on versus the propaganda can be pretty profound. There's a variety of pair trades in the energy and commodity world that we look at every day as sort of indicators, like a cockpit indicators as to how the plane is flying, and happy to get into any of those. But the markets will tell you whether they think Iran is going to close the strait.
Right.
And sometimes the market gets it wrong, but as far as indicators go, markets are pretty efficient because there's real money on the line. And that's where I think the development of these predictive markets is very, very interesting psychologically and financially, because nothing like putting a few bucks on the line to express a view that sort of elevates it from troll to information.
Yeah, I mean, when the rubber meets the road, that you really have to, putting your money where your mouth is, really changes the dynamic about how agnostic you actually are being about a bet like that. We had an interesting conversation not too long ago with Chris Abdelmessi, and we talked about predictive markets, and the basic question was, if you're going to make a yes no bet, a binary bet like that, or you're looking at predictive markets for guidance, you have to really ask yourself beforehand, what's my edge? Do I have one? Do I know something the rest of everybody else doesn't know, first of all? And secondly, do I really know? And secondly, am I smarter than everybody else collectively?
Yeah, that's the sort of fundamental question of all investing.
Yeah.
And the thing that's interesting about predictive markets is they're small and still inefficient. So you don't have the brutal arbitrage that you do, say, in the oil and gas markets, where you have, billions and billions of dollars being traded on the smallest of nuanced advantages. But I do think markets are still pretty inefficient, especially in the era of meme stocks and proliferated betting. So as the marginal investor is being gamified on their phone, Robinhood, Reddit, Twitter, that brings with it opportunities and challenges. I think, for example, back when we were active on Twitter, Twitter was much faster than Bloomberg. Twitter was a wonderful source of raw information, and the skilled user of Twitter could convert it into actionable information pretty quickly. And so I remember watching markets and seeing something on Twitter and thinking, oh, stock A, B, and C is going to run on that news. And then you see the red headline on the Bloomberg terminal 4 minutes later, and stock A, B, and C run on that news. And so as efficient as they are, they're still imperfect. And the name of the game, of course, if you're trading, is to try to time that. If you're investing, it's a whole different situation, of course. It much depends on your time horizon.
Yeah. Well, speaking of mental models, we're really trading under a new paradigm. And one of the mental models that you argue about is that, and I want to come back to oil, is that when markets speak of oil, they no longer just mean crude oil. Why does that semantic mistake cause investors to consistently misread price signals?
Yeah, it's a great question. So the shale revolution has changed a lot of things. Most importantly, it turned the U.S. into a net energy exporter, and it made the U.S. a global hydrocarbon gigapower. It's the world's leading producer of oil, which is a word that needs to be spoken with precision. It's the world's largest producer of natural gas by a wide margin. It's home to one of the largest coal reserves in the world. And so that's one thing. That's the first order obvious thing. But the second order, perhaps not obvious thing, is that the era of co-production is upon us. And so in important shale patches in the U.S., crude oil, natural gas liquids, and natural gas are all co-produced together in meaningful quantities. And anybody from industry who has ever competed against a co-producer can tell you that that radically changes industry dynamics. So what do I mean? Let's say a co-producer produces A and B together, but you only produce A and I only produce B. We don't like that co-producer. If A is expensive, they will produce both A and B and dump B. And so if you produce just B, that's a bad day for you. And you now have to pay attention to both the market for B and the market for A, because you have somebody in the middle who's producing both. And so the way this has worked right now is because of OPEC, crude oil trades at a premium on an energy content basis relative to the other hydrocarbons. There's a lot of reasons for this, not just OPEC. Society has built the engines necessary to take full advantage of crude oil, and engine switching comes at a cost. But because crude oil is at a premium, drillers in the Permian are drilling for as much crude oil as they can get, and they're dumping natural gas and natural gas liquids onto the market. And so if you're just a pure play gas producer in Appalachia, that's not a very good day for you, because there's this enormous tsunami of natural gas coming onto the markets. Now, what we've been arguing is there's a world where that value delta switches, and because of AI-driven demand for natural gas becomes valuable. And in that world, drillers in the Permian will dump crude for whatever they can get in their search for natural gas. And when that pivot comes, crude prices will be quite bearish. And so in the long run, all the hydrocarbons on the board should trade for the same price corrected for energy content and logistics. That's the law of arbitrage. And when you plot energy content today in the U.S., natural gas is the cheapest, natural gas liquids is in between, and crude oil is expensive. And so when you're looking at the price of crude oil in isolation, and you're looking at inventories in Cushing or, OPEC pricing in Asia, you're missing an entire part of the market that is influencing that market, which is what's going on in natural gas and NGLs in the U.S. And so the very definition of oil is undergoing a molecular semantic shift. NGLs are already counted as oil and have been for a long time by, the Statistical Review of World Energy is just one example. So the U.S. today produces 13 million barrels or 14 million barrels of crude oil, but it produces 20 or 21 million barrels of, quote, oil. And on CNBC, you hear about Cushing all the time, but do you ever hear about Mont Belvieu, which is the natural gas liquids capital of the world? And you don't. And so in the old heuristics, you're flying a bit blind because there are substantial, powerful forces that are occurring in different parts of the world that you never had to pay attention to before, but you do now because of shale. That's just two of the consequences of shale. A third is the speed with which you can go from spud to refinery is shrinking dramatically, which means inventory numbers don't matter as much as they used to, because the time signal from when a refinery needs a shipment to when it can be delivered is shrinking. And so back to this whole efficiency and resiliency argument, the speed to respond with the U.S. shale patch is just changing the game. And so one of the challenges we see with all of the metrics being used, any backward-looking metric in the energy space necessarily underestimates the impact of technology. A rig today doesn't mean what a rig did 5 years ago.
Right.
And so historical rig counts are comparing old rigs to new rigs. And that just makes the analysis more difficult and more challenging. Even recently with this natural gas mini spike in the Gulf Coast, there isn't a price of natural gas. There's spot, front month, futures by region.
Yeah.
And so, yes, February Henry Hub went crazy, but everybody's trading the March Henry Hub, and that's just the last remnants of closing out the contract before it expires today. And so I saw headlines in the Financial Times yesterday that, natural gas went up by the most in 10 years. It didn't really, because that's just the last of the February contract. And everyone's off to trading March, which is, $3.70 a million BTU today, not the $6 and change that February is trading at. That's an artifact of a winter storm. And by the way, industry players aren't even paying those prices. And so, there's just an enormous amount of nuance that comes from the molecular complexity that we're seeing. And that's one of the many themes of Doomberg is trying to pull that out for our subscribers.
What do you think the timeline is on that transition from natural gas being the undesirable side product to it becoming the main main dish and the crude oil dumping beginning?
So look, it already trades that way in Europe. Landed liquefied natural gas trades at parity to Brent crude. So if you just take the Dutch TTF contract in dollars per million BTU and you multiply it by 5.8 and you plot it against Brent crude, they trade in lockstep most of the time. And in fact, that's one of the pair trades we look at for crisis indicators. When those things start to deviate, something is wrong somewhere in the global hydrocarbon complex. And so why does landed LNG in Europe trade for the same price as Brent crude? Because people still burn oil to make electricity. Surprisingly, 4 million barrels a day are burned to make electricity, and the primary use for natural gas is to make electricity. And so things that do the same thing literally don't sell for different prices for very long. And you have that arbitrage. If the world stopped burning Brent crude or stopped burning crude oil to make electricity, that pair trade might deviate. But as long as there's still several million barrels a day of oil being burned to make electricity, you can expect that pair trade to be tight. In the U.S. today, there's an enormous amount of natural gas in certain parts of it. And if you build up enough data centers and run them on natural gas, then you could begin to see convergence. Look, when we wrote a piece called Generational Arbitrage, the ratio of WTI divided by Henry Hub was over 50, and it should be 6 energetically. And it's now, in the teens. because things that do the same thing don't sell for different prices indefinitely. And so you have to look at regions, you have to look at molecules. Look, if it rains a lot in Sichuan province, that's bearish for coal prices in Appalachia, because the Chinese will toggle between hydroelectricity and coal-fired production. And the Chinese are big players in international coal markets. And so this fungibility is always increasing. Arbitrage is always being ground away. And we have huge molecular arbitrage on the board today. And so one of the trends that I think is safe to bet on is, hey, this company is facilitating the closure of an identifiable arbitrage. That's a company that's very interesting to us,
right,
to invest in, because physics is a tailwind in that case.
Yeah.
So energy
I suppose it's the existing infrastructure of the use of energy. And
right.
so in Europe, you've got that parity, but in the US, you don't quite have the data centers built yet. And it looks like there's sort of a backlog of trying to get the turbines that would turn natural gas into those electrons. And so that gap has to close. But that to me is like, that's years, right? Is it? Or how do you see that gap closing and how?
It depends where you are.
Right, of course. Yeah.
But in that world, midstream players are extremely valuable.
Yeah.
Turbine producers have been on a tear.
Uh-huh.
Alternatives to gas turbines to generate electricity from natural gas. Think Bloom Energy. It's had an incredible run. Solid oxide fuel cells. In the long run, arbitrage is a powerful tailwind, and engines will be switched. Humanity wasn't destined to use gasoline for cars, diesel for trucks, and jet fuel for planes. It doesn't have to use those things. That just perfectly matched the composition of the marginal barrel of crude oil available on the market when those engines became standardized. We're seeing engine switching in China from diesel to LNG for trucks. You don't have to power planes on jet fuel. You could power them with other hydrocarbons. And so when the spread of the fuels is large enough to justify engine switching, let me give you an example of something we just wrote about, propane.
Right.
There's an enormous amount of propane in the U.S. Propane is the second most prevalent natural gas liquid behind ethane. It's a very clean burning fuel. It's not quite as clean burning as natural gas, but it's a little easier to handle than natural gas. And so it's a push, and 80+% of grain drying in the U.S. on farms is done using propane. And there's a lot of diesel being burned on farms. So if you already have the infrastructure to accept propane on your farm, large tanks, maybe you get a dual fuel tractor, and the emerging glut of propane that's coming, you burn more propane than diesel. Yes, it's not quite as good from a work perspective, but if the cost spread is big enough, you can swallow that. And so you can see how it doesn't take much in the way of switching for these prices to converge. So this is why we're endlessly fascinated in where are the deviations and how do they get closed. Physics as an edge is still real in our view, and most importantly, because very, very few people understand it. So you can have a durable edge in that regard.
Yeah, it's a significant tailwind that helps push the advancements along rather than fighting ahead.
The bottleneck's a constraint. So one more example, produced water is becoming a constraint in the Permian. If a private company was doing a fundraising round with an innovative solution to deal with produced water, I'd be very interested in seeing that pitch, because anything that debottlenecks the production of energy is valuable because the human endeavor needs more and more energy. So the volume of energy is always increasing. The price of the energy is always decreasing. So the value is in the companies that could unlock more energy. Midstreamers, service providers, royalty plays, all of those types of things.
Fantastic. I think the audience will be particularly interested in those, and do your own research on that. But those are some good guidelines to start looking into, whether you're looking at individual companies or exchange-traded funds that cover sectors, to start thinking that through in the portfolio. I think generally speaking, if we think about the 60-40 portfolio that is kind of predominant, let's say a starting place, and the allocation, the market cap allocation within that, it seems to me that is sort of sorely underexposed, the various areas of energy production and metals and minerals and that type of thing.
Absolutely. Yeah.
Yeah. I mean, you really want to have a diversified exposure, because if you're betting on oil producers, that's very one-dimensional. And, you really want to look at diversification across, as you said, Doomberg, across, the midstream segment, energy infrastructure, any energy infrastructure and storage, like, what companies are in between that are delivering. There may be this abundance of natural gas, but somehow it has to get from the natural gas producer to eventually the electricity producer who burns natural gas to create those electrons.
Yeah. Not only
Right.
is natural gas not valuable until it finds a machine that can use it, it's a nuisance. It's actually a cost, which is why
Right.
we see in the Permian and in Western Canada sometimes spot natural gas trading for negative prices, because it is our friend Sir JJ at Market Vibes, and another great Substack, likes to say oil is worthless until it gets to a refinery.
Yeah.
Um,
Well, to your point, I mean, you brought up what the natural gas LNG spot price is in Europe, trading close to Brent. That's because it has a usefulness in Europe that it doesn't have quite yet here.
And while Europe is short energy and the U.S. is
Right.
long it, and so getting energy from, and by the way, they are proactively shutting off a supply of energy vis-a-vis Russia. And so they have to replace that energy, and thus far they're doing it with U.S. and Qatari LNG. But that's expensive. You have to pay for the cost of capital of all of the entities that touch those molecules, from the field to the midstreamers, to the liquefaction plants, to the cargo ship, to the regasification facility, to those midstreamers, to your power plant. And so, yeah, that spread between $3 a million BTU at Henry Hub and $10 a million BTU at the Dutch TTF contract, that spread is paying for everybody in between. And so your electricity producer in Europe is paying more for their natural gas than your electricity producer in Texas.
Yeah, and you said something interesting earlier, which was that there's this influx of capital in the private equity market and perhaps also the private credit market that's just looking for these in-between infrastructure opportunities to invest. And it's a very long cycle. We're not talking about, stuff that's going to happen in the next 12 months. We're talking about things that are going to unfold over the next 5 and 10 years.
Yeah, absolutely.
Right?
And
the capital is there. So even though, critics have said, an LNG plant costs $20 billion to build, it's not as though the capital isn't there to do it.
And once built, these assets are immortal.
Yeah.
The ultimate sunk cost fallacy was looking back at what LNG Canada costs. I mean, it's in the ground now. Now you have a market to unstick British Columbia natural gas. And so it's going to be produced.
Yeah.
So
as to your point, Mike, I mean, if you're unsure about specifically what to invest in this sector, in the energy sector, then, the easy way is to take a broad approach, take something that's very well diversified, that covers all of these areas, the midstream, the infrastructure, natural gas levered businesses, integrated energy producers like you talked about, Doomberg, and have broad exposure to it. And there's any number of ETFs that can provide that broad exposure. And if you are interested in getting more specific, then you can obviously drill down and look more closely at the areas that excite you a little bit more, or that you find a little more compelling.
Yeah, I look at it and say, well, the S&P 500 is sort of, 5% energy, 3 to 5% in the energy sector, and given
it's so underinvested,
exactly, and given the impact that energy has on everything, it seems to me that is just a function of market cap weighting and the love of technology, which, if the AI boom is real and these hyperscalers are real, they're going to be consuming a fair bit of energy. And so it would seem to me the market cap would need to expand in that area, but not necessarily, as you point out, Doomberg, there's no shortage of hydrocarbons. We have to get them, in areas that are well regulated and have access and can process them. But that area seems to me to be an area that may be underrepresented from a market cap weighting perspective, and represents some sort of, maybe a risk to sort of the classic 60-40 portfolio.
Yeah, we would say you have to pick your spots. So let's just take energy producers. We're generally not long those. We wouldn't recommend being long those. Why? Because they are price takers that are constantly deflating the value of their own product through technological investments. And so the long-term real price of all commodities is lower. Why do I want to own a producer of such a product that is putting themselves systematically into lesser and lesser profit?
Exactly.
Because they're price takers. But the midstreamers and the other enablers or arbitrage closers or debottleneckers are very interesting. And so I do think energy is so underinvested that it's a rare opportunity for a good stock picking portfolio manager to make a big impact too.
Yeah, and I really want to emphasize this point that you make, Doomberg, right? It's the energy companies that are the ones pumping it are not the ones that are going to benefit the most.
I mean, so look, if you want a good, stable, well-run company with a dividend, go ahead and buy Exxon.
Yeah.
But Exxon's a price taker.
Yeah, right. It's going to be those that are involved in, as you say, in that midstream area. Anyway, I think that is
the price makers.
An exceptional. Yeah, getting it to market, processing it in between market, getting it to the places it needs to be, in the right format that's required. That there's a lot of work in that area, and
there's a lot of alchemy in that too, right? I mean, if you're the end delivery company, and you can find, a way to turn lead into gold, that's very profitable, right? I mean, to be able to take something that's nearly worthless and turn it into something that's costing as much as Brent, like in the case of LNG in Europe, that's compelling.
Yeah, those opportunities are on the board for sure.
Yeah. So the in-between plays, the picks and shovels.
Yeah, exactly.
Yeah. All right. I think we covered the idea that technology has broken the key indicators. Like, if you're still looking at oil from the historical model, that's time to rethink that mental model. The conventional ways of thinking about oil production and oil profits. I want to get into the topic of China. One of your really interesting pieces was war rations. In war rations, you talk about how China has been stockpiling all commodities, metals, grains, copper, nickel, gold, obviously we know, right? And behaving very much like they are gearing up for a kinetic war.
In that piece, we talked about one of the most interesting things is China's been buying an extra 1 million barrels a day of oil for the better part of a year and just sticking it underground. Makes one wonder where the price of oil would be if they weren't doing that,
right,
and where it'll go if they stop doing that. But there are two ways to interpret that. One is that this is preemptive defense, i.e., China's economically vulnerable. Crude oil is one of its largest vulnerabilities. Let's plug our nose, pay the working capital price of negating that vulnerability to the maximum extent possible so that we can harden ourselves against an economic blockade, which frankly is not out of the realms, given what we're seeing, attacks on Russian shadow fleet and the snatching of Maduro in Venezuela and so on. And so it's not crazy to think that it's prudent to do that. But the flip side of that coin is that it's also what you would be doing if you were preparing for a preemptive strike. And everywhere we looked when we researched that piece, we see a coin that has two sides on it, but consistent stockpiling of militarily relevant supplies on a scale that is unprecedented. And given the rumors that we saw over the weekend about a coup in China, these things happen every 6 months. I tend to fade those. But it was an interesting provocative thing to put out there. And we get a lot of feedback when we put those pieces out there, which is part of our work process, of course. And so that was a pretty interesting one. Yeah.
To me, I think the thing that helps me clarify when I look at the action, both of the U.S. and of China in these contexts, is if you look at it through a wartime economy, things seem to make a lot of sense.
Yeah.
You're disaggregating global trade. You're starting to separate the trade so you're not dependent on the other person, and you're stockpiling and rationalizing supply chains and building in redundancy. If you look at that through a wartime framework, it's kind of spot on.
Yeah. And then look, sometimes these things are self-fulfilling.
Right.
You know?
Gosh,
unfortunately.
Yeah. Yeah.
I mean, it on the outside, as you point out, it looks it looks irrational, and that's how it's being described by a lot of mainstream media. Is just that
Yeah.
Is it that you can't understand or you don't want to understand what this behavior is?
We always hesitate to ascribe irrationality to China's behavior.
Yeah, I don't think they are irrational. And I also wonder about the implication of Venezuela vis-a-vis Taiwan and that sort of thing.
Yeah.
How that's going to play out in that theater, and if maybe those things haven't been worked out already.
Well, this is a great example of reading everybody's propaganda. I could tell you how the Maduro affair was portrayed in China, which was green light for Taiwan.
Yeah, right. Precisely.
Yeah.
And this to me, and I don't know, who knows what's going on behind the scenes for that, whether that's some sort of peaceful transition down the track that is some middle ground that keeps everybody less unhappy.
Or is it, yeah.
It's an interesting gambit, to be sure. And looking at it through that wartime framework is, it starts to make a lot more sense to me anyway. And I know people don't want to look at it that way. It's not kinetic yet, I suppose, but anyway,
it's pretty darn close.
Yeah. At the very least, I would suggest even like that, if they're looking at the U.S. and saying, if the U.S. can do this, if Trump can do this, then so can we. And I mean, that I know you already unlocked that statement, which is the green light for Taiwan. But maybe it's a continuation of, brinksmanship and détente, but having China realizing with the Trump administration that they need to have more leverage.
Yeah. So
we can do this if we want to. Just look at us now. Look at where we are now. We have the biggest military in the world. We have this huge navy. We can take Taiwan whenever we want, if we want. So as long as you play your cards right, we won't do that. Right?
So let me frame this. Let me frame it to you in the way we think about it. The Venezuela affair and the Iran decapitation strike are signaling to the world that we're entering a regime of might is right. Trump said as much. I'm not bound by international law. I'm bound by my own morality.
Only.
In a world where might is right, you better have a pretty good measure of everyone else's might.
Right.
And I think that certain Atlanticist neocon types in D.C. are radically underestimating first the might of Russia and more urgently the might of China on a go-forward basis if we're truly entering into a new phase of might is right. And that's dangerous.
But is it a new, instead of a two-hemisphere Cold War, are we now in a tripolar Cold War between the U.S., China, and Russia? Is everybody sort of heaving up their chests and saying, if you can, we can. If we want to, we can. If we want to, so you better, keep that in mind before you.
Those are the main actors,
yeah.
Pierre. But Japan and China right now, Pakistan and India.
Yeah.
Are you really going to have the B in BRICS be in the Western Hemisphere as a stable state? Putin labeled Cuba an ally, which is a different word than he used to describe Russia's relationship with Venezuela. It's not just three. You're fragmenting into a whole series of regional instabilities that were suppressed by the sort of strength of the U.S. Navy and its dominance. And if that's all going away and if the U.S. is pulling back, all manner of historical grievances are going to come to the fore. And the basic operating assumption of a rules-based international order where trade is mostly fair and disagreements are settled collectively, United Nations, WTO, if all that's going away, then it's quite chaotic.
So what are the investment themes that fall out of this? Do you buy China here? Like how do you
again
translate this into something that is
so heavily depends on everybody's individual situation? But
of course, not advice.
Broadly,
should
sure.
do their own research on this. Absolutely. Do not go out and buy the things that we talk about without doing your research.
100%. This is not advice, right?
As a broad rule of thumb, everything that worked for the last 50 years is unlikely to keep working in the new regime. And so that would argue against a 60-40 portfolio, because who wants to own bonds when all of the West is debasing? So for example, just take what was common knowledge and understood and reverse it, and that is a very good place to start.
Like Charlie Munger, invert.
Yeah, always invert.
Yeah. So broad commodities?
Again, depends on where you are in the supply chain.
Right.
And we don't count gold as a commodity, by the way. So
right. So precious. I know you know we've talked about precious metals in this conversation already, but it kind of speaks to that play on resilience that you previously talked about.
Exactly.
And I mean, it is the reason behind gold's big moves.
Yeah, well, I mean, again, I think it's a bit of a long discussion, but treasuries are no longer considered neutral in their role as reserve assets, and gold is still neutral. And so we're seeing gold displace treasuries in market share of central bank reserves, which are used for the settlement of imbalances in international trade. So that's at least one of the forces driving gold higher.
So what about what about energy and industrial inputs? I mean, I know that speaks to commodities, but we're talking about raw materials, metals.
Yeah, so it depends again on the industry sector and the supply demand forecast. That's why the whole co-production thing that I talked about earlier makes it particularly challenging to do this. But broadly speaking, when we look across critical inputs, again, our interest is in those who enable them to get to market. So all commodities, we're doing a Doom Zoom Pro Talk, for example, in February on copper.
Okay.
And the title of the presentation tentatively is Copper, Super Cycle or Mostly Myth.
I can't wait, by the way.
And there's just a huge amount. There's one of the fascinating things about resources and commodities, inputs as you call them, is just a huge base of people that just really want to get long them. And so I saw a post on Twitter, a picture of the Vancouver Resources Investment Conference this year. It's packed to the house. And 5 years ago, it was empty. As the person who posted the picture on Twitter said, they had to fill out the agenda with cannabis companies. Right? And so we're at that phase in the cycle where people are excited to own resources again. And look, palladium, platinum, copper, silver, gold, they're all running. And that's great. But as our friend Tony Greer likes to say, high five with one hand and make a sale with the other, because these are highly cyclical and all shortages lead to gluts, especially in a world that has an infinite supply of all of these things from a modeling perspective, which it does. And I know that's a statement that some people scratch their head at. There can't be an infinite amount of copper. There's an infinite amount of copper. All it comes down to is time and price. And so trying to catch those waves is a fascinating thing that people love to do. But in the long term, the real price of all commodities is lower. Just plot copper. Even today's elevated prices in ounces of gold are plotted in CPI adjusted prices. And you'll see that copper producers are price takers, just like all commodity producers. And for that reason, they're just less interesting to us, even when they're very interesting to everybody else.
So, but is there the gap between, I guess, demand and supply that we'll be facing for the next few years of the build out that requires all of these atoms to make real what are, the vibes around AI and all that sort of stuff?
I mean, there are spots where you'll see shortages, but as we'll talk about in this copper presentation, there's an enormous amount of, let's just take copper. So you can recycle copper. Copper is an immortal metal. 80% of the copper ever mined is still circulating in the economy today. The world doesn't recycle all that much copper. It might produce, I don't know, 24 million tons of copper from mine, then another 4 from recycling. Every year that extra recyclable material stays in the economy is actually bearish for the price of copper, because in a pinch, if prices get high enough quick enough, we'll go fetch it. And it'll get to the recycler, and it'll find its way in. Just like right now, silver's all the rage.
Right.
There's thousands of years of junk silver floating out there in the world. Yes, the mining response to silver is relatively inelastic because very few mines are opened and dedicated to the production of silver. But there's an enormous amount of silver, grandma's spoons.
I remember when they were melting them down in here.
Oh, yeah.
The Hunt brothers cornering of the market.
This happens, right?
Yeah.
And so there's a cap
And
beyond
people,
which...
people are stealing it too, right? People are stealing copper, and they're stealing
Sure.
silver.
And that was, half the price ago.
Yeah.
And so the one thing that is perpetually underestimated by people who have a desire to get long resources is the supply response and the creativity innovation cycle that comes with making a few bucks that drives people. It's the hidden hand of the market. So the full title of the piece is Copper Hype Cycle, Super Cycle, or mostly hype, shortages, gluts, and the hidden hand. Like, yes, there might be a temporary shortage in some pockets of the world, and all of those arbitrages get closed. And so one way to play those markets is to try to time the presence of those spikes. Our preferred way is to fade them after they materialize, because at least that now you're in the middle of a spike, right? Because all shortages are followed by gluts. The supply response is not only innovative, it always overshoots. There's no discipline in the supply response. And how could there be? Because you don't know that everyone else is doing the exact same thing at the same time, chasing that same dollar of arbitrage.
Even if you do, the music plays, you have to dance.
Yeah.
And
right.
to create the mine or to create the thing will only be done when it's popular to do so and profitable to do so, and the price is high and everybody's interested. And then eventually it goes through the same ebb and flow and bust and boom. I mean, that is the process.
Right. So do you want to be the person that is building the mine?
No.
Right.
Yeah.
Maybe if I'm the engineering company that is
employed,
that
like you're selling a service.
Yeah. Right.
That's different.
So some of that is sort of harkens back to on the oil and natural gas side is there are benefactors, but they're maybe not the actual underlying commodity producers.
And the thing that seduces people, like, is every once in a while that trade really works.
Yeah.
Right? And so, like, every once in a while the VIX explodes. It doesn't mean I want to be long it every day as it grinds away at my premium. So when the VIX does explode, what happens? It fades.
It reverts.
Now,
It
it can be expensive to play that fade.
Yep.
But, yes, Iran might close that strait and oil might go to $150. And I don't doubt that it would. I'd wait for it to retrace back to 125, and then it's going to be $40 within 6 months.
Are there any?
Because,
It's far more predictable. It's harder to do, but it's far more predictable.
Yeah.
Correct.
Are there any critical minerals that defy that?
None that I'm aware of.
Okay. So like uranium falls into the same camp.
Oh, God, no, there's so much uranium, Mike.
No, that's what I'm
saying. How much?
Yeah.
Like,
and the production.
But to process it is the problem.
Processing of it. So there's
right.
lots, I guess the uranium is plentiful. The processing is the problem.
Right. And so, but while uranium is plentiful and processing is the opportunity.
Right.
Yeah.
Right?
Of course.
And so, like, what the U.S. and many in the West call nuclear waste is partially spent fuel that can be recycled. Right? There's an enormous amount of uranium in the world. There's a huge mine of it in Saskatchewan, like we talked about in Tempting Target. Everything is cured by price, and producers always overshoot. I saw Sprott was out with a new ATM, and they're going to buy up more uranium, and it's going to create a shortage. Well, that's going to eventually create a glut. And so you can trade it both ways, but you have to be very disciplined to trade it on the way up. It's a lot easier to wait for it to spike and fade the Icarus Prince, in our view.
Now exactly. That piece, Tempting Target, which was all about Saskatchewan, like what a terrific highlighter, what a terrific piece to really, bring Saskatchewan into the forefront of consciousness. Because, I think a lot of Canadians, it startled a lot of Canadians for sure. But it also speaks to more widely to, Venezuela, Greenland, Trump's bluster about Governor Carney in the 51st state. And Saskatchewan often gets overlooked as an afterthought. Like Alberta usually takes the center stage when it comes to energy resources because of its oil. But Saskatchewan really highlights what makes resource-rich, low-population regions strategically vulnerable in the world that we're in now.
Yeah, it's a great story. Thanks for bringing it up. We like to occasionally write about Canada. First of all, because our American readers know so little about it. And we do have a pretty strong cohort of Canadian subscribers who like Doomberg, which is great. And if any of them are listening, thank you for your patronage. And if you've gotten this far and you're not yet subscribing, you know what to do. But Saskatchewan is the size of Texas, and it has 1.25 million people in it, and it has an enormous resource base that has been largely taken for granted in Canada, let alone the rest of the world. And so, in the same way that we predicted Greenland, Venezuela, all the way back, in Misreading the Room, we wanted to lay down a marker that as long as Trump is going down the grocery aisle with a shopping cart and lots of room on a credit card, there's a few other products for sale, maybe not for sale, a few other products that might be tempting as targets, hence the name of the piece, for Trump to agitate for. And if you're going to suddenly call the Western Hemisphere your stomping grounds, to borrow a phrase from Stompin' Tom, Saskatchewan's got pretty good value proposition.
Yeah, it does.
Food, lumber, uranium, oil, gas, potash, and one that we forgot, frankly, at oversight was helium.
Yeah.
Should have wish we did. When you see it in the comments, you slap yourself like, God, why didn't we include a paragraph on helium? Another strategic resource that is in abundance in Saskatchewan that the U.S. is short of. And so when you see that, and you see the miscontent, and by the way, as we said in the piece, Eastern Canada has kind of mistreated Western Canada, both real and perceived. And so there's a sort of a strain of resentment to Ottawa and Quebec, say nothing about the Maritimes, that the Western Canadian, which, by the way, traces much of their cultural heritage and identity to the U.S., there's much more in common between Idaho and Montana and Alberta and Saskatchewan than Alberta and Saskatchewan and Quebec and New Brunswick. Physics says that that's a metastable state, ripe for disruption. And as unrealistic or as far afield as it might sound now, physics has been a very useful guide for us. And, why, when I visited Saudi Arabia, the sidewalks are paved with gold. That's a mild exaggeration, but the people in Saudi Arabia that you see as a Westerner visiting there are enormously wealthy. Why does the average person in Saskatchewan not enjoy such wealth?
Right.
The resource base per capita is off the charts, which tells you that the people of Saskatchewan don't own those resources meaningfully, which means the people of Saskatchewan could, in theory, be enticed for a better deal. And that's basically one of the things we really enjoy doing, which is starting with physics, mix in a bit of analysis of the current state versus what it should be, and then ponder, how do you reach that equilibrium? What are the kinetic catalysts you need to close the current state to one that is more natural for the residents of Saskatchewan. As we said in the piece, Saskatchewan is tied with Nova Scotia for the highest poverty rate in Canada. You have 1.25 million people sitting on a Texas worth of resource. It's just an interesting question, isn't it? And so it
is.
It just reframes things in a way that opens up a few other questions, like who is controlling those resources and why haven't the people of Saskatchewan been remunerated proportionate to the bounty? Very similar situation in Australia, of course. The old British Commonwealth countries, perhaps uncoincidentally, are incredibly rich in resources, which is how they became members of the Commonwealth in the first place. And so the full independence from the old rules is not yet there, clearly, as evidenced by that analysis and other similar ones that we've done.
So Canadians have not shaken that historical mindset.
Well, they're being robbed by Quebec.
They're
I mean,
yeah. Look,
sorry.
I mean
what
the contract between Canadian citizens and the resource base of Canada is clearly, let's use a very polite word, suboptimal. By all measures, the average Canadian should be incredibly wealthy. 6 million barrels a day of oil, 20 BCF per day of natural gas, world-beating institutions, technologies, lumber, minerals, metals, in a population of what, 35 million? Last I checked,
40?
A tenth. Yeah, I haven't been keeping track of the immigration numbers, I guess. But still a tenth of the U.S.
Right.
And Canada, the average Canadian is doing well, but I could go on to some of the cultural things in Canada, but I don't want to.
I think one of the problems, yeah, go ahead, Mike.
How did Canada get so involved in the whole carbon neutralization trade and the fact that I always harken back to that old Mad Men opening skit where he's like, our tobacco's toasted. And I look at that and I say, the natural resources from Canada, they're toasted. Like it's a good political regime with good rights for workers, good production quality of those underlying resources. People should pay a premium if they're so concerned about the environment to buy the natural resources that Canada produces. Yet we've done many things in the last decade to sort of undermine that and be ashamed of it to some degree. And I'm always perplexed by that.
And we would call that a giant psyop.
Right.
Because that's what it is.
Yeah.
I mean, China does not hesitate to produce 56% of the world's coal and probably burn it.
Mm-hmm.
And then to flex its geopolitical muscles because of that strong foundation. China runs on coal.
Yeah.
Some of the dirtiest coal in the world.
Yeah.
With the least pollution controls, which is sort of a priori exposing the hypocrisy that you're trying to articulate, Mike. Talk all you want about the carbon intensity of the oil sands in Alberta. If you had to select a place to work, would you work in Alberta or in a coal mine in China? I think the answer is pretty self-evident. There is this cultural difference between the U.S. and Canada. I mentioned Stomp a Tom earlier.
Yeah.
The lauding of labor in Canada is pretty prolific. And if you live in the U.S. and you spend any time in Canada, you see the big difference. The U.S. capital is held up as the thing that you should strive to be. The difference between labor and capital, of course, is, self-evident. Whereas in Canada, an honest day's work, forced solid paycheck with benefits and stability permeates the culture. And I think that's why the people of Saskatchewan don't necessarily internalize themselves as owners, i.e. capital, of that resource base. And who knows whether that's by design or just a cultural accident of history. But I could tell you that it's a profoundly different thing in the U.S. The mindset of capital compounding equity versus sort of the steady paycheck are just two wildly different aspects of the culture.
I think it has a lot to do with the risk willingness of Canadians, first of all. And so when the domestic companies that are looking at developing resources like Alberta or Saskatchewan or anywhere else in Canada for that matter, the tendency is probably to get impatient because Canadians aren't in a hurry to invest, large amounts of their own capital, or institutions might not necessarily be in a hurry to invest large amounts of capital into exploration and development, production. We have a long history as a country of doing that, but it's not enough. And so when companies are looking for much more sizable amounts of capital to further develop those resources, they inevitably end up going to the U.S. for that. And then the U.S. ends up, or foreign investors end up becoming larger investors in our resources than we do. And so we kind of forego ownership because we're a little more careful. We're a little too careful. But outsiders are seeing the opportunities in Canada and more than happy to step up, whether it's China, the U.S., or European mining concerns, Australian mining concerns, even like some of the huge commodities producers that are based in Australia and in Europe. They're more willing to put the resources, the capital resources and the money into our projects than we are, or we have been historically. And then you add to that, you compound that with the last 10 years that you were talking about, Mike. Like, we got talked into this zero carbon future and Paris Accord, so much so that we underinvested in our own backyard. It's not stopping American companies from exploiting ownership of our resources. It's just that we stopped ourselves.
Yeah, so I wouldn't be too hard.
It's kind of sad.
I wouldn't be too hard on yourselves either, though. We often compare quite favorably the arc of Canadian resource development to that of Venezuela. Both blessed with very similar sized hydrocarbon accumulations, different geologies and chemistries, but similar enough that you could squint at it. And, Venezuela used to produce 4 million barrels a day. It now produces less than 1, and Canada's crossing 6. There's lots of positive things happening in Canada, too. And especially now that Carney has played the role of staring down the climate stuff and is repositioning Canada to properly take advantage of its embodied resources. And so I think much more to be bullish about the future of Canada than the average Canadian probably feels.
I mean, are we ascribing too much uncertainty to our own future?
Well, if you had to pick a place to start out in the world, in Canada is not a bad start. Beautiful country, lots of land, enormous resource base, very good institutions, very strong, cohesive culture, even though it doesn't feel that way sometimes. A lot of tailwinds. If you randomly pulled out of a hat from the list of however many countries there are, and you landed in Canada, that's a win. Take the W.
Yeah.
So.
Well, I think we all agree on that. I think we agree on the idea that Canada is a great country. It's just that maybe we need to put a little more collectively more faith. And I think this past year has been an eye opener, like a wake up call for Canadians to look inwardly as opposed to always looking, south of the border, or the other side of the fence where the grass was, greener because of tech stocks and things like that, domination of U.S. equity markets. But we've turned a corner, and How does this translate into a Canadian investment opportunity in terms of where can this be actionable in your estimation?
I think it's the same set of answers that we give for American resource development.
Right.
If you're in the pipeline laying business, that MOU is probably pretty good for you.
Yeah.
And if you're an early stage E&P sitting on a resource that suddenly might get connected to a pipeline, well, then okay, that's interesting to us. If you're in Saskatchewan and helping to bring those resources to market, again, like there's lots of opportunities. And again, starting with energy, and Canada has an enormous amount of energy.
Yeah.
And so using our own prism, Canada is lots to be bullish about. And so the ways to play it are the same ways that we've been talking about for this whole appearance.
Perfect. Excellent.
Doomberg, is there anything, Doomberg, that we missed? Anything that's sort of hot on your radar that we have not covered?
No, I think we covered a fair bit.
Certainly.
In the hour and a half that we've been going. And Trump is nectar from the gods for a content creator. And he's also quite maddening because you're always one Truth Social post away from having to tear up what you've been doing and start over. But it's been an incredible year, 2026 already. I think January has lasted about a year.
It has.
That's how it feels. And so there's no shortage of things for us to talk about, but I always enjoy my time with you guys.
And us with you. And at Doomberg.com. And as you mentioned, you got that insiders presentation that you're doing for the Doomberg Insiders, of which I am a paid subscriber, by the way, and looking forward to that. And I'm sure if you get your subscription in immediately, you can be part of it as well.
Yeah, we have our annual subscription for the newsletter, and then we have a pro tier for the monthly webinars in addition to that. And then we also have a sister publication, Classics Read Aloud, launched by one of the Doomberg co-founders and its current editor, or its longtime editor-in-chief. You can find that on Substack as well. That's a really great project in its own right. So you'll find everything at Doomberg.com, including links to Classics Read Aloud. Pierre, Mike, it's always great. And we always talk about so much. It's very exhilarating. Last thing I'll say is to all of our Canadian subscribers who may be listening, thank you very much for your business. We certainly appreciate it.
Amazing.
Doomberg, thank you. Thank you for your incredibly valuable time. It's wonderful having you.
Appreciate it. Looking forward to the next time.
Mike, wow, what an episode. Such an eye-opener, such a wake-up call to have Doomberg on. The funny thing is, it's one thing to read his articles, but it's a whole other thing to actually hear it straight from Doomberg.
Agreed. Energy is life. Doomberg is famous for saying that. Energy is integrated into every part of our lives and is critical. And when you wake up and your phone's charged and your fridge has been on all night, this constant power that we have all the time at reasonable prices is a huge part of our everyday living. Not to mention what makes up big portfolio inputs for people to consider. And he always has a take that is very unique. And it can be a little bit difficult to pull out what does it mean for the investment portfolio at times.
Yeah.
And I think that's what we're trying to do here. And I do recall he mentioned Argentina. I remember in the bailout of Milei. And I know that's been that there's an Argentinian ETF that trades in the US. And if you look at that, it's got this long basing pattern, and just recently it's broken out to new highs. And if you look at Latin America in general, in aggregate, again, there you can look at the ILF ETF. You can look at EWZ that represents Brazil as well. And all of these have gone through these very long periods of consolidation and are now breaking to new highs. That to me is interesting. And he mentioned Argentina. We're seeing what's going on in Venezuela. If you look at South America as a whole, I think this is an opportunity for diversification for those North American portfolios to some degree, just because of price action, as well as some of the geopolitical consequences that have come out of that. And I thought that was just an interesting observation as we were going through some of the things we're chatting. I know we have others. When you're looking at price action taking to new highs, that's always very interesting to me because there's a new paradigm in the way people are thinking about the investment theme when that happens. And
Yeah, and
go ahead.
Yeah, I was just going to say one thing that Doomberg really highlights throughout the writing is that we are hanging on to that bias that we're still living in a world where everything is stable trade, stable politics, stable energy flows. That's not the world we're moving into. Not only has the economic regime changed with inflation, we turned this corner on inflation in the last 5 years, and interest rates coming off the bottom, 10 years of zero interest rate policy. Ultimately, that's not the only change that's occurred. Like, the other change that's occurred is the power dynamic. And we've had a year now to digest all this uncertainty and instability caused by this radical policy making that we're seeing coming out of Washington. And instead of stable politics, stable trade and energy, and stable energy flows, we're actually seeing all this bluster about national security, resource security, energy independence, physical infrastructure becoming strategic again. And markets haven't really, investors, maybe even advisors haven't really, we want to hang on to the old regime, the old paradigm, but because it's so much nicer to consider or to contemplate.
I think it's the formative years as well. So you have the formative years.
Yeah, we've
grown investors out there that are used to, interest rates declining, bonds and stocks not being correlated, so they offset one another wonderfully. The threat of inflation has been subdued for better part of 50 years. And that all is being turned on its head.
The confusion, I think, one of the big takeaways is that energy isn't just another sector, right? It's not just another sector bet anymore. It's becoming, because of this AI boom that we've had the last couple of years now, it's becoming everything. It's becoming the whole system. Like, at the core, we are going to depend on all this energy that we have a surplus of to drive electricity. But the problem is a time problem. It's not whether or not we have enough oil or whether or not we have enough natural gas. We've got it in abundance. The problem is that it needs to get to where it's needed.
Absolutely.
And so if we're still looking at abundance as a reason to be, there's the case, obviously, that with all that abundance of oil, now we've got Venezuela that might come on stream in the next 5-10 years for the North American hemisphere. That might hurt Canada. That might hurt the energy producers. That might hurt prices. Prices, we're in the 50s for oil. And people are looking at that and saying, why would I want to buy energy? Why would I want to invest in energy producers? And that's understandable. That's palpable to sit there and think, I don't want to own an oil producer, just a pure oil producer, because every time the price goes down, their stock goes down. Or I have to depend on the price going up in order for it to be a profitable trade down the road. But that's not where the opportunity really is, right? The opportunity is not in the oil producers per se. It's not that there isn't an opportunity. Oil producers have become very efficient, very, very good at finding profits through efficiency, through technology. So I'm not dismissing oil. It's easy to be dismissive of oil and energy in general because of the abundance. What's more important is understanding how all the plumbing works. Like, how do you get the natural gas that's almost free to the power plant that drives the AI data center?
How do you get the turbines,
for example,
in the power plants that actually are required? And I think what was interesting is there's this abundance of hydrocarbons, and mainly the challengers are one of legislation or regulatory. Does the place where it's being produced actually have friendly rules and laws around its development? And then it's the transportation. And so what was very interesting with Doomberg is that producers are price takers. And if you get higher prices, there's one cure for high commodity prices, and that's high commodity prices, because it brings on more production. And it's unlike a scarce asset, right? Gold, is only increasing by 1 or 2% a year. So a scarce asset must be bought from somebody else, right? It can't be produced. Whereas if oil does increase in price, more wells will be drilled and more technology will be employed and you will get more of it. And there's no discipline there. So producers are price takers. And where we want to look is this idea of where's the energy required? Where does it need to go? And what needs to be built to alleviate those bottlenecks in supply to get it to where it needs to go. And this was a theme with Doomberg about that midstream area of the market, and sure that the service providers that are servicing the oil and gas industry, those are the areas you want to look, those who transport it everywhere. And something that came to my mind in Canada, a well-known and beloved company is Enbridge. Enbridge is probably the Mac Daddy of the veritable goat, if you will, of that type of situation where, this is one of the most energy infrastructure-like equities in Canada. And it's a cash flow business tied to moving energy and its related services rather than just being built as a pure commodity bet. So that came up as an idea. Again, because that's not, I want to say it's not investment.
Yeah, not
do your own research on this. But that's something that came to my mind as a specific company that would be able to take advantage of the theme that Doomberg was talking about.
And if you think about it, we take Enbridge for granted because that's the company that delivers gas into our homes. If you're thinking about alchemy, that's one form of alchemy that can take something that is in abundance and nearly very inexpensive to produce, but needs to be delivered. So it's the delivery that matters of that commodity, of that natural gas. The other thing that was interesting in that price making, toll taker discussion was the arbitrage between LNG natural gas prices in Europe versus Brent. And I thought that was really interesting because that really illustrates what the opportunity is for Canada or for the US, being abundant natural gas producers, overabundant natural gas producers. How do you take something that's nearly worthless and how do you take that lead and turn it into gold? How do you, and you do that by making it accessible, by delivering. What was the word?
Fungible?
Stranded?
Yeah. So a lot of the natural gas is stranded, as you say.
Yeah.
And so you've got to move it to the right place where it can be consumed. And and as you say, there is an abundance of it. And that is a theme that I think has got some legs to it for sure.
Yeah. And if we're on the theme of resilience and commodities, for example, that is something we take commodity prices, commodity supply for granted until something breaks. And that's where the resilience argument comes in for having exposure to commodities, whether it's the commodity itself or picks and shovels, service companies that actually deliver the commodity, companies that transform the commodity, whether if we're talking about industrial inputs. We saw it, frankly, during COVID, during the COVID-19 episode where, things got into shortage. There was supply chain disruptions. It's those supply chain disruptions that are the potential problem. If there's any kind of geopolitical conflict that interferes with the delivery of a commodity, then you get disruption. The interesting thing that Doomberg pointed out was that it's very hard, obviously, to time commodities. So maybe one way, instead of timing it, maybe one way, and this is not Doomberg's suggestion, but maybe one way to look at commodities is to have it as a strategic investment, as a strategic holding, the commodities themselves, like physical commodities producers, trend following strategies that invest in commodities like CPAs.
That's where I was going to go. Obviously, a topic near and dear to my heart.
Yeah.
But the idea of being a CTA, so, whether it's managed futures, bigger space, but whether you're using trend or carry or multi-strategy approach, looking at that suite of not just stocks and bonds, but stocks, bonds, commodities, and currencies, and looking at investing in those from a long, short perspective. So those portfolios can be either long or short those assets. And so this really hits on the point that Doomberg makes is that whilst commodities may go through their spectacular bull markets like we're seeing in silver at the moment, things will happen to close those arbitrage gaps. And eventually the shortness of supply becomes a surplus of supply. And you get these pretty radical price swings, which is where in a trend following context in the managed future space, where you're going to be able to be active and adaptive and add that layer over top of your stocks and bonds. And it's why it's so complementary. So from my perspective, obviously managed futures is a great way to just one-stop shop, be a little bit more thoughtful about exposures to the commodity space. You could have a strategic allocation or an active allocation, and you've got to think about the individual investor's preferences at that point.
Yeah. Hey, look, do your own deep dive and look at what's out there. What energy infrastructure diversified plays are there? What plumbing and picks and shovels plays are there for natural gas, for oil, for any of the energy, for uranium, you can go broad. There's many different ways, obviously, to get the exposure. You can go broad, you can go narrow, you can go specialized, you can get into CTAs and managed futures. It just depends on where you are and what you're looking for in terms of adding resilience to a portfolio. There's lots of very nifty ways. We hope that we have piqued your curiosity with this conversation today enough that you are on that pathway, taking the steps, if you haven't already, taking the steps to look at how you can build additional sleeves into your portfolios that provide that resilience and that exposure to those key themes that are being shaped by today's regime.
Yeah, and your starting place is going to matter. If you're an American investor and the S&P 500 is your base, 5% of that portfolio has any energy exposure and de minimis metals and mining exposure as well. Whereas you step across the border to Canada and all of a sudden you've got an economy that's dominated by resources and financials. And so it presents a little bit of a different problem. What is the actual sector makeup of where you happen to live? The Canadian dollar denominated TSX, you're probably going to have some exposures there, and various Canadian companies that are going to have a lot more of this exposure to the commodity bull run, if we want to call it that, in all its ways and shapes and forms. And it just is, I think a lot of Canadian portfolios probably have a fair bit of US exposure at this point, and probably it's tech oriented rather than resource oriented. The nice thing is for those Canadian portfolios that's sitting on their Canadian exposures, those do have quite a bit of those natural resources built into them. So that's one natural hedge, just in owning a North American portfolio for a Canadian investor. On the US side, if you're an American investor, it's far more concentrated, and you've also got more choices. So if you're looking at midstream, you can look at some of those master limited partnerships in the US and some of the ETFs represented by those areas, because they are the transportation of those hydrocarbons. And so again, a great
not subject to not subject to price volatility in the commodity itself.
Correct. And so I think that those are quite a number of ways to take a look at the portfolio that you may have for individual investors and say, okay, what are my blind spots? What am I missing? What should I be incorporating today to make that portfolio more resilient given what's going on in the world?
Awesome. Mike, until next time.
Love it.